Chart patterns, symmetrical triangles. Definition. A symmetrical triangle is when prices converge towards a central point. This happens because the bulls and bears are both at a decision point. The bears are absolutely sure the prices are going to fall. The bulls are absolutely sure that the prices are going to rise. Whether that happens or not is an open question. A pattern does not develop because people want it to, it happens because of objective situations. On this chart, every time the market rallied, the bears started selling. Every time the market dipped, the bulls bought. It turns out that every new sequential peak is lower than the last, giving us the upper trend line, the red line going down. And every new sequential trough is higher than the last, giving us the lower trend line, the red line going down. Once you've reached the end of the pattern, the edge of the point, a decision needs to be made. Suppose we're in an uptrend and we get a continuation pattern. We know that the markets need to continue up. So if we break out, the bears who were short selling will now start to buy, further fueling the rise. Breakdown. A symmetrical triangle is the most common triangle chart pattern. It is comprised of price fluctuations where each swing high or swing low is smaller than its predecessor. This coiling price movement creates a structure of a symmetrical triangle. As a symmetrical triangle is forming, trading activity diminishes along the way until the apex of the triangle is reached. Many technicians believe that if a stock is rallying prior to a symmetrical triangle, the stock will eventually break out to the upside. Conversely, if a stock is falling prior to a symmetrical triangle forming, the stock should continue lower. Both of those assumptions are wrong. Symmetrical triangles provide little, if any, indication as to which direction the stock will ultimately break out. Remember, from the above definition, there is a lack of volume and price movement which creates a coiling pattern. Therefore, it is simply impossible to assess which way a symmetrical triangle will inevitably break out. Symmetrical triangle breakout. There are two key components to a symmetrical triangle breakout: price and volume. For a breakout to the upside, you want the stock to close decisively outside of the triangle formation with a pickup in volume. Breakouts to the downside also require a decisive price break of the formation, but the volume does not need to display a significant increase in activity. If you notice a pickup in volume on a breakdown, odds are it is a false signal and the stock will likely reverse to the upside. Symmetrical triangle breakout chart example. You see a classical example of a symmetrical triangle on a chart. If we draw a horizontal line through the right edge of the triangle, we will divide its angle into two equal parts. This is the requirement we need in order to confirm this pattern on the chart. Also, notice the lower level of the triangle starts later than the upper level. In a real symmetrical triangle on a piece of paper, the two sides need to be equally long. However, on a chart, this is impossible. The reason for this is that the stock price is unable to draw a top and bottom at the exact same time. After all, the x-axis on every stock trading chart refers to time. Also, notice that the initial symmetrical triangle breakout on the image is bearish. The price first breaks the lower level of the formation. However, the price then switches directions and breaks the upper level of the triangle with a big bullish gap, which comes with the new trading day. This is a normal outcome when trading triangles, especially the symmetrical triangle. After all, the direction in which the triangle will break is unknown before the appearance of the triangle. For this reason, if you see the price peaking through one of these levels, this doesn't mean that you have a breakout. In many of the cases, it might be better to wait for the price to develop before concluding that there is a breakout. Identifying the real breakout. A great trading tool for spotting real breakouts is the volume indicator. The reason for this is that real breakouts usually happen during high trading volumes and high volatility. The fake breakouts appear during low volumes and they look more like a range rather than a breakout. Since the levels of any triangle are inclined, a ranging move sometimes brings the price outside the frames of the triangles. This way, traders get lured into thinking there is a breakout on the chart. Let me show you how to spot real symmetrical triangle breakouts with the help of the volume indicator. Symmetrical triangle pattern. Above is a 5-minute chart of General Motors from May 12, 2015, where a symmetrical triangle developed over an entire trading day. In the red circle, we see a fake breakout. Notice that the volumes during this breakout are relatively low and stay low over the next few periods. Later on, we see a bullish breakout when the trading volumes are increasing. This is the real breakout which should be traded. Symmetrical triangle target. Every chart pattern you trade should tell you what your target is for the trade. The reason for this is that chart patterns have a target which is well known to the more experienced traders. Remember this, when you trade chart patterns, your minimum target equals the size of the pattern itself. This is an important rule which you should always be in your mind when you trade chart formations. The symmetrical triangle formation is no different. In order to measure the symmetrical triangle size, you first need to extend the shorter side to match the length of the other side. The size of the third side of the triangle, which is missing, is the size of the price move you should pursue. Symmetrical triangle price target. Above is the 2-minute chart of Citigroup from April 14, 2016. The blue lines on the chart form the symmetrical triangle. However, I've added an extension of the upper level, the red line on the chart. This way, you can measure the third side of the symmetrical triangle. Have a look at the arrow on the green area between the two sides of the triangle. Its length is 46 cents. We take this length and we apply it right after we identify the breakout in the formation. This is the minimum target we should pursue when trading the pattern. In this case, it appears that we have a symmetrical triangle reversal scenario.